the next slide. So that kind of.
Is there any way to tell how many people are attending the session?
Most of the deal happens while we're doing that countdown. So, but yeah, it's still it's about give or take.
Same here, Mark. I can hear a little background discussion going on. That's better. Are we ready to get started? Thank you, Mark. Welcome everybody to the next session of the CARES Act CDBG CV training session. We're going to be dealing with a portion of the basically CDBG training that HUD provides to all CDBG grantees. And the portion that we're going to be dealing with specifically is the financial management issues related to your programs. With that, I want to briefly turn it over to the other two people who will be working with me today and ask them to introduce themselves. Michelle, you want to introduce yourself briefly?
Thank you, Bill. I'm Michelle Bush with Corporate Facts. We're a HUD technical assistance provider, and we have a lot of expertise in financial management and 2 CFR 200. Thank you.
Thank you, Michelle. Dion?
Good morning, everybody, and welcome back. This is Dion Roberts. I last saw you yesterday morning, so hopefully you've had your coffee and you're ready to go one more time.
Thank you, Dion. And I'm Bill Roeder. I'm with Corporate Facts, consulting firm that works with HUD programs and grant recipients. And you'll probably hear me from time to time referring to my previous life. I was a HUD employee for 38 years in HUD field offices in Fort Worth and Oklahoma City, and then at the end of my career in Kansas City. So we'll from time to time be leaning on some of that experience. What we're going to cover today, we're really going to talk about 6 broad issues related to financial management. We're going to start by discussing the general overall administrative and planning requirements and how to calculate that, and hopefully give you some advice on how to make sure you're doing that properly so you don't artificially inflate the amount of money that you report that counts against your general administration and planning cap. And while this is not a major issue in the regular program, it's a significant issue in the COVID funding era. And that's the issue of pre-award costs, those costs that were incurred prior to you receiving your grant funds. So we'll talk about that a little bit. Then we're going to discuss program income and a related subject known as miscellaneous revenue, and help you understand what is program income and how it's to be treated, and what is miscellaneous revenue and how that money is to be treated. We also want to talk about revolving loan funds, which many grantees use for a variety of things, including things like small business loan or economic development programs. You also need to be aware of your regular CDBG timeliness test, as well as your CDBG CV timeliness requirements. So we'll discuss the timeliness test. And then lastly, we'll be dealing in some depth with the umbrella federal requirements related to financial management contained in the OMB requirements at 2 CFR 200. So those are the basic subjects that we're going to cover. Next slide, please. Okay, let's start with an understanding of things that are often misunderstood, frankly, by grant recipients that are dealing with the CDBG program. There's a tendency to think that all costs are the same and all personnel costs are the same, and they are not. We want to talk about general administrative costs or general administrative and planning costs versus what are known as activity delivery costs. Direct costs of carrying out a specific activity within your program are generally considered to be activity delivery costs. Examples include the costs of running a rehab program. Most entitlement grantees, for example, have some form of single-family housing rehab program. And most of the personnel costs related to that, such as taking applications, spec writing, and doing inspections, those costs are charged against the housing rehabilitation program and not against your general admin and planning cap. Other broader costs, and I like to think of them as the costs for administering your program as a whole, are considered general administration, and they do count toward that 20% ceiling. So I think everybody knows, both for the regular program as well as for your CDBG CV program, your general administrative costs are capped at 20%. So you have to be mindful of that. We'll walk through that. Dion, Michelle, anything you want to add?
No, I think that's a great job, Bill. Thank you.
Okay, next slide, please. So general planning and administrative costs, those things that do count against your 20% cap. Those are your general management and oversight and coordination functions. Again, I like to think of it as those costs associated with managing a program as a whole, as opposed to managing a specific activity within that program. You have two options in charging salaries. You can charge the entire amount of your salaries toward this cap if you choose, or you can count a prorated share. And I think most of the grantees I worked with chose a prorated share approach. We'll talk about that more later on. You've also probably heard about the issue of direct versus indirect costs, which is something you need to think about anytime you're dealing with a federal program. It's important that you maintain supporting documentation. And you'll hear us refer to that over and over again. As a former HUD person, what we oftentimes found was that grant recipients were in compliance with requirements, but they didn't have the adequate supporting documentation to demonstrate that. So supporting documentation is important. And in this case, that really boils down to two things: timesheets for personnel costs, and in some cases, an indirect cost allocation plan, which we'll talk about a little bit later on. Michelle, Dion, anything about that you want to say?
The only thing that I would add, Bill, is that to be mindful that indirect costs are not all necessarily admin costs. I think that's a point of confusion as well. Indirect costs could be program costs and it could be administrative costs.
So your electric bill might be an indirect cost, right?
That's right.
Okay. Next slide. Okay, other eligible administrative and planning functions that you need to be mindful of. Public administration or public information, all of those public hearings, for example, that you're required to have when you're developing your consolidated plan or your annual action plan. Those costs are normally considered general planning and admin costs. The cost of administering fair housing activities, which you know comes with your federal funds. Those are general planning and admin costs. The cost of preparing your consolidated plan, and that would include the substantial amendments that most of you had to develop for your CDBG CV funding. So those costs are normally charged as general admin and planning costs. You can also use CDBG to pay for the cost of submission of applications for federal programs. Oftentimes, as you know, CDBG is used in companion with other federal programs, for example, in a disaster situation. So those costs are normally general admin and planning costs. The costs of your overall management of things like an EZ or EZ, a number of you have designated empowerment zones or enterprise communities. Those are general admin and planning. And a number of entitlement cities that also receive home program funding use their CDBG funds to pay for the general admin and planning costs related to the home program. That's permissible. And then your overall planning, policy work and studies, those kinds of broad-based activities would be considered planning and admin costs, and again, count toward that 20% cap. Next slide. So again, this is kind of a repeat of what we just covered, but just a reminder that the costs of dealing with your empowerment zone or enterprise community are eligible, and the cost of administering the home program would be eligible. Next slide. Now, the next 3 slides we talked about earlier, these were added to this slide deck at a time when most grantees were going through the transition from the old accounting system to the new grant year-based accounting system that went into effect in 2015. Most of you, probably all of you on this session, this is no longer necessary because you have now made that transition. So we're going to kind of go through these slides very quickly because I don't think they're going to be applicable to you under the current situation. So next slide. And this was just a way to illustrate how the old way was used to calculate your 20% admin cap. Next slide. And again, this was another way to show you how to make that calculation, but you don't use this approach for your 2015 and later grants. And based on Treasury requirements, most of you don't have any grants going back beyond 2015. Next slide. Okay, now let's take you into the current period that you're working with, the post-2015 period. And fortunately, in terms of calculating your administrative and planning cap, life got somewhat easier for you with that transition. First of all, these rules, which is your expenditure test, not your obligation test like you used to do in the old days. Your expenditure test applies to any of your grants that you received from 2015 and later. You limit your planning and admin expenditures to no more than 20% of each grant. And that's important because that's a change from the way it used to be done. This excludes program income in that calculation. So you're tracking each individual grant through its whole life cycle, and you have to make sure that you don't exceed that 20% cap for any individual grant year. So compliance on that count, as well as the other requirements, will be determined at the end of that grant. We'll talk later on about how you make that determination. When does a specific grant begin and end? If you want to know the details that are contained in your CDBG regulations, you can look them up at 24 CFR 570 200 G1. And then I know the previous session dealt with IDIS. We'll show you later on an example of where you can look into IDIS to see how you're doing, the PR26 report, activity summary by individual grant, and that will help you determine how you're doing. And incidentally, my experience in all those years at HUD working with CDBG, it was very rare that any of our grantees exceeded the 20% general admin and cap. And part of that was we did stress this issue about making sure you're not charging activity delivery costs toward that calculation. Dion, Michelle, anything you want to add at this point?
No, thank you.
Okay, next slide. So it's important as a reminder that not only for your regular CDBG program, but also for your CDBG COVID funding, that 20% cap applies to both programs. But with CDBG CV, you're dealing with a distinct, separate grant or grants. And again, if you want to check to see how you're doing at any given point in time to make sure you're not getting close to, heaven forbid, you're exceeding that 20% cap, you can go to the PR26 reports and you can check to see how you're doing. Next slide. Okay, here's an example of a PR26 report for a particular grant. I think this one is for a 2014 grant. But obviously the same thing would apply currently. You simply scroll down there and you can see in that column that's circled, that is a calculation of how you're doing or how this grantee was doing for that particular grant year in terms of their overall administrative and planning expenditures. Next slide. Okay, here was a chart that was developed again to show you the differences between the pre-2015 and the post-2015 rules. For our purposes, we will just look at that right-hand column. If your origin year is 2015 or later, which is the case currently, you're going to follow that expenditures test rule that we just walked through. And that rule tests for your CDBG funds expended, not obligated, like in the old days, for planning and admin over the life of the origin of that year's grant. So from beginning to end for each individual grant year. And the big difference here is that program income is not part of that calculation under the current approach, while it was part of the calculation under the previous approach. Okay, we have one poll question that we would like to share with you. Can we take, there we go. Please take a moment and respond to this poll question. Are all personnel costs considered to be general administrative and planning costs to be charged against the 20% cap?
And Bill, while people are responding to the poll, it might be a good time to just let them know that you're planning to cover questions at the end so that I know some of the other sessions, they've been done sort of on an ongoing basis. So I just want to make sure folks know that they are going to be addressed when you get to the end of your presentation.
Very good. Thanks, Dion. Again, the key here is, are all personnel costs considered to be general admin and planning costs? Okay, I think we're getting close to full response. The answer to this is, the key is not all personnel costs are considered general admin and planning costs counted against that 20% cap. Remember that discussion we had about what are called activity delivery costs. So if you've got a single family housing rehab program and you've got people who do your application intake and inspections and work write-ups and cost estimates, those personnel costs are not charged against your admin and planning category. Those are charged against that particular activity, which in that case is single family housing rehab. So keep that in mind as you go ahead. If your number gets unusually high, my experience has been, you probably better take a second look and make sure you're not inadvertently charging activity delivery costs against that admin and planning cap. Okay, next slide. Okay, this is an issue that we rarely dealt with when I was at HUD, but is a significant issue, particularly with your CDBG's COVID funding, because we know a lot of communities had to expend a lot of money prior to receiving your CDBG COVID funding. So there is a provision in the CDBG rules that allows HUD to deal with that, and that's called pre-award costs. Those costs incurred prior to officially receiving your grant. So those costs are incurred prior to the effective date of the grant agreement. And the grant agreement effective date is the latter of your program year start date or the date the consolidated plan was received by HUD. or in most cases, that would be the substantial amendment to the consolidated plan was received by HUD. So that's when the clock starts, so to speak, officially on your grant. The activity for which you want to be able to get reimbursed must be an eligible CDBG COVID-related activity, obviously. That activity must also meet all of the cross-cutting federal requirements that we'll touch on later on, things like the environmental review requirements and Davis-Bacon and the Uniform Act. And they must be in your action plan or your amended plan. So when you did your substantial amendment, or in some cases, you were actually in the process of developing an action plan or a consolidated plan, those costs must be included in that plan in order to be considered pre-award costs. The total must not exceed $300,000 or 25% of your grant amount, whichever is greater. So for those recipients that received a sizable COVID funding grant, it might be over that $300,000 amount. And then another thing, because we know states are involved as well, be aware that pre-award rules for states apply at your unit of general local government. That's that term that people use, UGLUGs, units of general local government, because keep in mind, states are administering this program for the most part through local governments. So those rules would apply to those local governments, and states can consider pre-award costs for them as well. Next slide. Okay, now let's talk about program income. I have spent a considerable amount of my consulting career dealing with this issue. It's amazing how often people get confused about what is and is not program income. But it's important that you understand this and you identify and you deal with program income correctly. So what is program income? Stated broadly, it's any money that comes back to the grantee or your subrecipient, such as a nonprofit group, that is generated through the use of CDBG funds. Examples: proceeds from the sale or lease of real property that was acquired or improved with CDBG funds. Those proceeds would be considered program income. Can also include the gross income from the use of rental of real property, personal property acquired, constructed, or improved with CDBG funds. So those funds are considered program income, and we're going to talk about how those funds have to be treated. Next slide. Again, what is program income? Here's some other examples. The payment of principal and interest on loans made with CDBG funds. And there's an exception to this rule we'll touch on in a minute. Proceeds from the sale of loans or obligations secured by loans made with CDBG funds. When I first read this, I wasn't quite sure what they were talking about, but I know that some grant recipients bundle up their portfolios of loans. For example, you've got a long-standing single-family housing rehab program, loan program, or a small business loan program, and sell those on the private market. Those receipts that you receive from that would be considered program income. It would include interest earned on program income pending its disposition. So if you happen to earn a little these days, that's probably not a lot of money, but it could happen. And funds collected through special assessments on properties that are not owned by low and moderate income persons. What does that mean? Most of you who have dealt with CDBG for a while know that there's a general prohibition against special assessments for people who are low and moderate income. But there are not limitations when it comes to people who are not low and moderate income people. So in some cases, that might happen. And if that happens, that's considered program income. Okay, next slide. So let's talk about what is not program income. And here's where I think some of the confusion comes. First of all, any amount in a single year that does not exceed $25,000. In other words, a very small amount. If your total program income for a given year is less than $25,000, it's not considered program income. It'll be treated as something we'll talk about in a minute called miscellaneous revenue. It does not include income generated by some Section 108 activities. Many of you familiar with the Section 108 loan guarantee program? The reason this is in there is because proceeds from those are oftentimes pledged as security for that Section 108 loan. So those amounts of income are not necessarily charged as program income for your CDBG program as a whole. It could include proceeds of subrecipient fundraising. If they want to raise funds, even if they're funded with CDBG, not for the fundraising, but as an organization, those would clearly not be considered program income. And funds collected through special assessments that I mentioned earlier, when it's on individuals who are not low and moderate income. And then subrecipients, those organizations that you fund through your CDBG program, typically nonprofit groups. Subrecipients proceeds from the disposition of properties 5 years or more after grant closeout. So you've had a long-standing relationship with a subrecipient, and at some point that relationship ends. These rules apply for 5 years after the closeout of that subrecipient grant. Michelle, Donna, any comments so far about this?
No, doing a good job. Thank you.
Okay, next slide. So let's talk about the use of program income. So those funds come back to you. What do you do with them? The first thing you need to understand is program income is considered to be just like any other CDBG funds. You must use those funds for eligible CDBG activities. So they are treated just like your regular CDBG funds. And they are subject to all of the regular CDBG rules and regulations. So they're somehow not exempted from federal procurement requirements, which we'll talk about at the end, or Davis-Bacon labor requirements, or environmental, the NEPA requirements that you have to do. Those program income dollars are treated just like regular dollars. Okay, we're going to touch on miscellaneous revenue in a minute. The one exception to this is miscellaneous revenue is not subject to these rules. So it's a much more flexible amount of money. And if you choose, you can spend up to 20% of your program income for general program and administrative costs. So you can use it for whatever purpose, including your general program and administrative costs. Next slide. Now let's talk about miscellaneous revenue. Again, if the total amount of program income earned in a single year from all sources, now that would be you as a grantee, as well as your subrecipients that you fund with your CDBG program. If the sum total of that is less than $25,000, that is considered miscellaneous revenue and does not have to be treated as program income. Funds earned from certain types of activities carried out by the nonprofits. That would include things done by community-based development organizations, that group of organizations that's contained in your CDBG regulations that are oftentimes exempted from other federal requirements or other CDBG requirements. And nonprofits that are serving local development needs. That would apply to state programs only. So there are some exceptions, but as a general rule for you out there, if your total of program income in any single year is less than $25,000, you can treat that as miscellaneous revenue and you can put it back into your CDBG program if you like, or you can use it for other purposes. Okay. Any comments so far?
Bill, the only
Okay.
thing I would note is that there are strategic reasons why they may or may not want to report it as program income, even if it is less than 25,000, and that they do need to keep in mind that deciding it's going to be miscellaneous revenue requires some forethought and planning, because if you get to the end of the year and you haven't reported any of your funds received and all of a sudden you're at $28,000, now all of those receipts become program income and some of them could potentially be quite tardy.
Very good. I agree. Okay, next slide. So let's talk about dispersing program income. As most of you know, if you have program income, you're required to spend that program income before you draw any new grant funds from your line of credit. Why? Because the US Treasury has to borrow money in order to fund your line of credit, and they don't want to borrow money if you have money on hand to pay your costs. So the requirement is you have to use your program income before you draw down any additional CDBG funds. Program income cannot be held for specific projects, and program income cannot be banked. As we said earlier, it must be spent first, and it must be spent just like any other CDBG funds. Now, there is an exception that we'll be talking about, and that's what's called an RLF, a revolving loan fund. Those are not treated the same way, and we'll deal with those in just a minute. Next slide. Okay, I don't remember this ever happening to one of our grantees when I was at HUD, but I guess it can happen, so we want to just make sure you're aware of it. There's a regulation citation 570-504B2 III. It talks about remittance to HUD of what's called excess program income. And what that means is that you must determine at the end of each program year whether you have excess program income on hand, and we'll tell you what that means. Those excess funds must be returned to HUD's chief financial officer for deposit in a separate account. In other words, it does not go into your line of credit. So if you do meet this requirement and you do have excess program income, those funds go back to HUD's chief financial officer. Next slide. How do you make this determination? The first thing you do is you determine the aggregate amount of program income held by you, the grantee, as well as your subrecipients. So you determine what that dollar figure might be. Then you get to subtract from that your immediate cash needs, because these are things you're going to have to spend that money on right away. You would also deduct from that a revolving loan fund balance. We'll talk about in a minute. Those funds are treated differently. Those funds remain within that revolving loan fund. You might deduct from that the lump sum drawdown balances. Many organizations, many grantees have a lump sum drawdown for things like single family housing rehab. And then cash used as security for a Section 108 loan guarantee. As I mentioned earlier, if you have a Section 108 loan guarantee, those funds are treated very differently because those are treated as security for that Section 108 loan. And so the last thing you need to take into account is anything in excess of 1/12 of your recent entitlement grant must be remitted. So we have a little chart to show you how that's done. Next slide. So here's an example. Let's say you're at the end of the year, or as Dion suggested, you're not there yet, but you're keeping an eye on it to see where you are. And you've got a total of $250,000 in program income. Well, as we mentioned, you get to deduct from that figure your immediate cash needs of $20,000, a revolving loan fund balance of $180,000. So that leaves you really with a program income balance of only $50,000. Your most recent annual entitlement grant was $1.9 million. 1/12 of that is $160,000. So in that case, you have not exceeded the 1/12 requirement, so you do not have to remit those funds to HUD. Next slide. So I mentioned a revolving loan fund, and it's treated a little differently, and we want to take just a couple minutes to explain that. What is a revolving loan fund? And from my experience, I think without exception, our entitlement grantees use this for economic development when they might be funding a nonprofit group or a CDC to carry out small business loan programs. That's probably the most common example of a revolving loan fund. It's a separate fund or account for a specific activity, as I mentioned, for maybe small business loan program. And it generates repayment because these are loans for that same activity, and that's important. Those funds must be used for the same activity, cannot be siphoned off for some other purpose. Hence the terming a revolving fund. Now, revolving loan funds must be in an interest-bearing account. Interest earned on the fund should be remitted to HUD, and interest paid by borrowers and loan repayments are considered program income. Dion, Michelle, anything you want to add about RLS?
The only thing I would say is that they are also often used for rehab programs, depending upon if that rehab program is actually a repayment and loan program.
Very good. Okay, next slide. Okay. Those of you who have been with the CDBG program for a while are well aware of the fact that there is a timeliness rule written into that program. And keep in mind that the rule is different for your CV funding. But we wanted to talk a little bit about your regular program because I've been dealing with some grantees that because of COVID, their staffing are overwhelmed and they're fearful that they might fail that regular CDBG timeliness test. HUD has signaled that they will try to take that into account in making these determinations given the circumstances we're under with COVID. But we wanted to just remind you of the timeliness requirements. Timeliness refers to how quickly the grantee is able to commit and expend CDBG funds. And incidentally, why does anybody care? Because at the time this rule was implemented, there was a very substantial amount of unspent CDBG funds around the country. And everybody was concerned that given that, there might not be another allocation of CDBG funding, given how much was out there. So HUD imposed a timeliness requirement to make sure that grantees don't accumulate excess amounts of funds that are not being spent in a timely way. Entitlement is not allowed to have more than 1.5 times its allocation in its line of credit and local program account 60 days prior to the end of its program year. So we used to tell our reps, mark your calendar for each of your entitlement grantees, mark their 60-day anniversary date, and check periodically to make sure they're on a glide path that'll get them to this number by that time. Now, if a grantee chronically, in other words, more than 1 year in a row, has more than 1.5 times their allocation in our line of credit, HUD can withhold future grants until the grantee effectively spends their existing resources. Typically, you'll have to do a workout plan of some sort that shows HUD how you're going to correct this problem. If you correct the problem, the issue is resolved, but if you do it again, then the remedies typically get ratcheted up. Keep in mind that this rule does not apply to the state program because states under the regular CDBG program, they subgrant their funds to small cities and counties within the state. So this rule really does not apply to a state like it does to an entitlement. Next slide. Now we're going to talk about our favorite financial management rules. And those are the umbrella requirements that are issued by the Office of Management and Budget. They've gone through a variety of permutations over the years with different names, but currently those rules are provided at 2 CFR Part 200. Those of you who love to read federal regulations, you probably will notice those are not HUD regulations. HUD's CFR is 24. These are Office of Management and Budget regulations at 2 CFR Part 200. They're often referred to as the super circular. And again, they apply to almost all federal programs, not just CDBG. So uniform administrative requirements. Next slide. Okay, that set of rules is fairly broad and it covers a variety of things. And we'll talk about them in some detail here. It begins with the premise that all costs must meet 3 specific tests. All costs must be reasonable. all costs must be allowable under that particular program or grant. And all costs must be allocable. And we'll discuss exactly what we mean by that in a minute. Okay, next slide. So what do we mean by cost reasonableness? The rule is written in a way that is not absolute black and white. It says cost is reasonable when it does not exceed what a prudent person would incur under similar circumstances. One of my reps once famously said the way to look at that is that if this expenditure is outrageously high, then it probably is unreasonable and it probably is not what a prudent person would do. But that's basically what the regulation itself says. So you just have to exercise some discretion here and ask yourself, what would a prudent person do? And then the rules go on to give you some guidance on how to do that. Consideration should be given to the following. First of all, is the cost that you've incurred, that you're going to spend CDBG or CDBG CV funds on, necessary and ordinary? Is it something a person would expect to see as part of your CDBG program? Were the prices comparable for similar goods and services? We always encourage grantees that anytime you're going to procure something with federal funds, and we'll talk about federal procurement requirements in a minute, it's always good to do a cost estimate in advance of that action, so you'll have some idea of whether or not the costs you're looking at are reasonable and they're what a prudent person might do. So the individuals act with prudence. Did they do this the way any normal person might do it? So it's kind of the way you carry it out. And again, we'll talk about that in greater depth later on when we talk about federal procurement requirements. And lastly, were there any deviations from set policies? We spend a lot of time working with grantees to make sure they have a policies and procedures manual. And that policies and procedures manual goes into some depth about how they go about administering their programs. Were there any deviations from that set policy? That's the sort of thing that would stand out and might not be what a prudent person would otherwise do. Next slide. So let's talk about allowable costs. What is allowable under your programs? 2 CFR 200 identifies allowable and unallowable costs. And there are some costs that are never allowed. In other words, these rules apply to all of your programs. And the most notable examples are entertainment costs, alcohol, and bad debts. So those of us who oftentimes have to put together travel vouchers or invoices, we often make sure that any costs of that nature are not included, that we pay for those out of our own pockets. Some costs are allowed, but with certain conditions. So there might be some items that you're funding that are allowable. For example, if your grantor agency, which is HUD, gives you permission to do it, you often run into that with equipment and supplies. So with certain conditions, some costs are allowed. And some costs depend on your federal funding source. Good example, your CDBG COVID funding. All of those costs have to be related to COVID, that tieback provision that people talk about all the time. So some costs depend on that federal funding source. Look to your federal funding source if you have any questions. Michelle or Dion, anything you want to add here?
No.
Okay, next slide. So allowable costs. What are the criteria that OMB defines as a basis for your determining allowability? Well, first of all, the cost must be reasonable. Going back to what we said earlier, what a prudent person would do. Did you pay 5 times as much for a particular thing as one might normally expect? That's probably not reasonable. Cost must conform to limitations. Example of the 20% cap on admin and planning, or the 15% cap on public services, which applies to your regular CDBG program. The cost must be in accordance with generally accepted accounting principles. And Michelle, would you like to say anything here about this issue about generally accepted accounting principles and how that comes into play?
Well, generally accepted accounting principles are the standards that OMB accepts for management of federal funds. And these are the same principles that are applied when you receive an audit. Your accounting policies and procedures should be compliant with those generally accepted accounting principles. And so if you're not certain, I would refer to your own internal policies and procedures to make sure that any costs that you're incurring comply with generally accepted accounting principles, also known as GAAP.
Very good. And we'll talk about that again in a future slide. The next thing that kind of makes sense is those costs must not be included under another federally funded program. In other words, you can't pay twice for the same thing. And they must be adequately documented. As I mentioned earlier, I think probably my experience has been more often than not, grantees are in compliance with federal requirements, but maybe they didn't document it as well as they should have. And those of you who have worked with CDBG know the record keeping requirements say you have to have adequate documentation to demonstrate compliance with all of the federal requirements related to that program. So document, document, document. Next slide. So what are source documents? Records must be supported by source documents. And those documents must explain the basis of the costs incurred. We incurred those costs under the CDBG grant. They were eligible costs per 24 CFR 570 subpart C, and they met a national objective. That's basically that those costs were incurred. Explain the dates of the expenditure. So somebody has a record of when those expenditures are done. That's particularly important if HUD comes out to do a financial management review, because they're going to pull some sample draws by specific dates and amounts. So you need to have the dates. And then the source documentation itself. Depending on what that expenditure might be, you'd have copies of canceled checks, you'd have copies of paid bills, and you'd have copies of your payrolls. So you know this dollar amount was matched by those particular source documents. Next slide. So now let's talk about cost allocability. 2 CFR 200-405 is a section of those OMB requirements that talks about what's called allocable costs. And this basically means determining where to charge costs. Some costs could be charged to multiple sources. This is important that you make sure that the cost you're charging to CDBG is charged appropriately. Process is known as a cost allocation method. And Michelle, you might want to jump in a little bit at the end of this slide, talk a little bit about cost allocation and how that works. You can develop a cost allocation plan, and that deals with both direct and indirect costs, as we mentioned in one of our earlier slides. And then, as Michelle mentioned, the generally accepted accounting principles provides additional guidance in this regard. Michelle, anything, or Dion, anything you want to say at this point about cost allocation?
The only thing that I would add, Bill, is that there's two methods for charging indirect costs. One is that you submit a cost allocation plan to your to HUD, or if you're a subrecipient, you submit it to your recipient for approval. It's a pretty complicated process, and we would encourage you to consult with your auditor or your finance staff to develop that cost allocation plan. But once that cost allocation plan is submitted and approved, it provides you with an indirect cost rate that you could use to apply towards your expenditures. The other option is what is known as the 10% de minimis rate. And so as long as your federal receipts are below $35 million and you don't have a current cost allocation plan, then there's a more simple method that you could use called the 10% de minimis rate. And that does not require any approval or any documentation to support using that rate.
Very good.
Right. And Bill, I would just add one thing, because a lot of grantees focus on allocability from the perspective of their subrecipients and their partners. And so it's really important for grantees to understand that they need to come to an agreement with their subrecipients and partners at the beginning about how they're going to allow them to allocate costs, have that documented and submitted to them and then approved, so that as they receive invoices, they can actually review those invoices and ensure that they're paying the correct percentage of the electric bill or the correct percentage of, the rent on that office space and other such things.
Very good. Okay, next slide. So OMB talks about an effective financial management system, and something we deal with fairly regularly in our consulting world. An effective financial management system must do at least three things. It must record all of your financial transactions. So there should be a single place you can go to see all of the federal or the financial transactions related to your CDBG program. They must relate expenditures to specific activities. So within your CDBG program, for example, there may be 5, 10, 20, 30, 40 activities that you're funding. Those expenditures must be related to those activities. And then lastly, you have to make sure you're in compliance with all laws and regulations. Those are inherent parts of an effective financial management system. Next slide. Back up one slide, I think. There we go. Thank you. Okay, the OMB requirements go into some depth about what's referred to as procurement, which is using your federal funds to acquire goods or services, basically. And those rules begin at 2 CFR 200-318. And those OMB requirements give you several different options, which we'll discuss in some depth. For those of you who have been around federal programs for a long time, OMB has added a new option called micro purchase, which I think is going to come in handy if you haven't looked at those rules in a while. So those rules basically describe the methods for procuring, selecting private for-profit administrators or buying goods and services. Grantees, state recipients, and subrecipients must comply with these federal requirements. And I don't know that we mentioned it enough earlier, but these terms oftentimes get confused. When we use the term subrecipient, we're talking about that entity, typically a nonprofit group, for example, or maybe even another government agency that you contract with to actually carry out some aspect of your program on your behalf. Those entities are subject to all the same requirements as the federal grant recipient is. So that term subrecipient has a very specific meaning in the HUD world, and particularly in the CDBG world. When you're dealing with procurement, you must also be mindful of some related requirements, including Section 3, which I like to refer to as project area hiring. Those requirements that ask you to do affirmative steps to reach out to project area residents and businesses to make them part of your program, as well as any state and local laws. So be aware that there are federal procurement requirements, but most of you also have to look over your shoulder and make sure that you're adhering to any state and local requirements related to procurement. You should also adopt written procurement procedures. Again, I've dealt with a number of grantees that had procedures, but they never put them down in writing, and there's no way to assure them that they're being carried out in a consistent, uniform manner. And those procedures, just common sense. What is the purpose of procurement requirements? To achieve maximum open and free competition. In other words, so you get the most bang for your buck. And the standards must cover things like standards of conduct. And also, it's important to take into account small and minority businesses, MBE, WBE, Section 3. Don't forget, you are required to submit annual reports to HUD on your Section 3 MBE and WBE performance. So if you don't keep records, if you don't do those affirmative steps, you're not meeting those requirements. So keep all of those things in mind when you're dealing with procurement. Next slide. Others that are covered by procurement. A grantee is not required to competitively procure state recipients, nonprofit public subrecipients. In other words, when you are awarding funds as a state to a sub-state grantee, you have to have what's called a method of distribution, but you don't have to award those funds on a strict competitive federal procurement basis. Now, once under a grant agreement, if these entities buy goods or services for their CDBG program, they must procure in accordance with federal requirements. So I mentioned to you subrecipients, entities carrying out aspects of your program on your behalf. They are subject to the same procurement requirements that you, the grant recipient, are subject to. In fact, they're subject to all the same federal requirements, not just procurement. There's also things called developers and beneficiaries not subject to procurement. A developer, let's say you're engaged in a large multifamily housing development project. That developer is a for-profit, profit-driven entity. And so they are not subject strictly to the federal procurement rules. The presumption here is that they are profit motivated and they will try to find the best, most effective resources that they can. However, a grantee may elect, if you choose, to impose those rules on those contractors. So that's up to you. But just be aware that contractors and developers are treated differently under these requirements. Next slide. So what are the specific options available to you under federal procurement requirements? The first one is the one I mentioned earlier, which is a new category called micro purchases. And that option is used for goods and services when the amount is less than $10,000. And it's a very informal process where you might go out and purchase from a local vendor, a computer or office equipment of some kind. For small purchases, that amount is now $250,000. So you can qualify as a small purchase. And again, the requirements for a small purchase are far less prescriptive than for the other categories of purchases and procurement that we're going to talk about. The next is the one that most people are familiar with whenever you're engaged in a large construction project. So you've got a construction project over $250,000, and you're going to go out with competitive sealed bids. The normal formal process. And this is one of those times when you also have to look over your shoulder and make sure that you're doing that process in accordance with state and local law. So that's the method used for large construction projects, competitive sealed bids. But then also you need to occasionally hire an architect, an engineer, or some other professional services for your program. And that's covered under what's called competitive proposals. You go out and you get proposals, RFPs or RFQs from more than one source, asked to submit those to you. Either a fixed price or a cost reimbursement type contract can be used. I think an important thing to keep in mind, though, is when you're using competitive proposals, you're not required to award the contract to the lowest bidder. Cost is a factor. Cost is definitely a factor, but it need not be the controlling factor. Because again, you're dealing with professional services and a lot of other issues like experience and track record and things like that come into play. So cost is a factor with a competitive proposal, but not necessarily the controlling factor. And then lastly, the one that when I do this, I usually put in bright red letters, non-competitive proposals what some people refer to as sole source kinds of situations, which come into play oftentimes when you have a public emergency, like a presidentially declared disaster. That's when you basically bypass these other options and you go out with a direct procurement without using the competitive process. I would simply caution people, while that's permitted under federal regulations, you should use it to in very, very rare and limited situations. And I always tell people, if you're going to resort to this option, it would be best to touch base with your HUD field office first, make sure they're aware of it, they understand the circumstances, and they're on board, because the non-competitive proposals are something that's almost a red flag for monitors and auditors. So it's there, it's permissible. One other thing, I live in the Midwest where, frankly, these dollar figures are relatively high. I don't think most of the people in my part of the country think of a $9,000 purchase as a micro purchase, or $250,000 purchase as a small purchase. The rules are that you can always adopt rules that are stricter than the federal requirements. You cannot follow rules that are more lenient than the federal requirements. So if you want to set a dollar figure that's less than 10,000 for micro purchases, or less than 250,000 for small purchases, be aware that you can do so. That's permitted. Okay, any comments about this so far on procurement?
I would just add, Bill, that last statement is really important, that, you know, you are responsible for complying with your local policy. So if your local policy is below that 10,000, you must comply with that. Your local policy has to meet these minimum standards, but you must comply with your local standards, not with the federal requirements if your standards are lower than what the federal requirements are.
Michelle, I recently had a case in Missouri exactly like this. They were dealing with the federal requirement, and then we looked up the state requirement and found out no, dollar limits were much lower than this. Well, they had to meet that lower limit. So they have to be aware of that. Any other comments about these methods of procurement?
One other thing I would just encourage is that if your local laws are more restrictive, you might reconsider what your local laws are, because some of municipalities don't realize that these dollar amounts have increased at the federal level. So you might want to have a conversation with your own procurement and with your own and review your own policies and make sure that you don't want to change your own local policies to increase those limits.
Very good. Okay, next slide. Accounting records. Good old accounting. Records should be sufficiently identify the source and application of your funds. So you start any accounting records by doing that. What's your source of funding? CDBG, and the application of the funds. At a minimum, the record system must have adequate internal controls, a chart of accounts, and transactions. Michelle and Dion, you want to jump in a little bit here and talk a little bit about what those things actually mean?
Well, your internal controls are typically spelled out in your accounting policies and procedures, and they would include activities such, policies such as you must have 2 signatures on a check, or 2 signatures on the approval of an invoice, or also your supervisor has to sign your timesheet. The chart of accounts is the method that accountants use to track your expenses. So you typically have an account number or an account code for every type of expenditure you might have. So salaries might all be applied to one specific chart of account code, or office expenses or things like that. So it's your accounting department that's typically establishing that chart of accounts that you're using. Anything else you would add, Dion?
I think that's absolutely correct. I did just want to go back one slide and note the fact that these slides have not been updated to reflect the change to the micro purchase threshold increase. Do be aware that that was increased to $50,000, I believe, about a month ago. But it does require meeting certain standards in terms of being in good standing and having being considered low risk and things of that nature. So it's not necessarily automatic, but there is the potential for micro purchase to be increased up to 50,000.
Very good. Now, I was caught off guard several months ago when they were increased the first, well, they get increased periodically, but these dollar amounts, I was still working off some old dollar amounts. So it's always good to go back to the 2 CFR 200 and they'll give you a reference to another site. There's another federal government site that sets these limits. So it's a good idea to always check. Okay, next slide. Okay, we're going to talk about the Single Audit Act. In the old days, we used to call these, I think, Michelle, attachment P audits or something like that, but it's now simply referred to as the Single Audit Act and single audits. Comes into play if you're expending $750,000 or more in federal awards in 1 year. If you are, you have to get a single audit. If you're less than $750,000, you're exempt from those single audit requirements for that year. The requirements can be found at 2 CFR Part 200.501. So those are the single audit requirements. Those are those independent audits that we often talk about. Next slide. So what are those requirements? First of all, you have to use a qualified CPA to conduct the audit. An entity out there that has not only basic CPA qualifications, but has the experience to perform this kind of audit, which is a very specific audit and specific standards. And Michelle, you and I have talked over the years about how that process has changed. My experience many years ago was that I felt like the single audits didn't go into enough programmatic issues, but now that has grown quite a bit, hasn't it?
Yes, that's right. There's more requirements for the single audit for auditors than there used to be.
Okay, the audits are due to a federal clearinghouse. So they go through a clearinghouse process first, no later than 9 months after the end of the fiscal year. And then those clearinghouses are supposed to send those audits once they've gone through that clearinghouse to HUD. And when I was at HUD, we would receive the audits, we would review them, and then we would obviously go to the last bullet that you see on that slide and determine whether there were any audit findings. And if there were, we wanted to work with that grant recipient to make sure that any audit findings were cleared. It's critical to make sure that those are cleared. Next slide. Okay, change in use. We understand that circumstances can change from the time you carry out a particular project or activity to years later. Circumstances change, and the rules in CDBG give you some flexibility in this regard, and we simply wanted to explain that to you. This applies to real property, that real property that you might acquire under CDBG. That's under a subrecipient's control, that was acquired or improved with $25,000 or more of CDBG. So you funded that subrecipient, that nonprofit, and they acquired a piece of property for more than $25,000. That piece of property is subject to these rules. Property must meet a national objective. National objectives: low and moderate income benefits, slums and blight, urgent needs. So that property must continue to be used in a way that meets at least one of those 3 national objectives for 5 years after expiration of that subrecipient agreement that you executed with them. Or it could be longer than that if you determine that it's appropriate. I know for some CDBG grantees that also operate under the home program, they often will go back to those timetables that are built into the home program and will require that this property be used for its intended purpose for more than 5 years. But the minimum requirement is 5 years after expiration of the subrecipient agreement. And if the property is changed in some way, they must return the funds at current market value, and the grantee must treat that as program income. It's called reversion of assets, and there's your citation. In other words, they would dispose of the property at its current market value. And then the proceeds from that disposition go back to the grantee, and those proceeds would be treated as program income. If you'll recall, we talked about program income basically goes back into your CDBG program and is spent right along with your other program funds. Reversion of assets, change of use. Next slide. Okay. The last thing we wanted to touch on in this presentation is the final piece about the change in use. It applies to real property under the grantee's control that was acquired or improved with $25,000 or more of CDBG, as we mentioned earlier. Now, if these are properties that let's say the city acquired with CDBG funds, you have responsibilities on change of use, just like a subrecipient does. So if you're in that situation, you must notify your citizens and receive comments on the change in use. Typically, you'd follow the same process that you would use for development of your consolidated plan or your annual action plan. And then the property use, the new use, the change in use, must meet a national objective for 5 years after closeout of an entitlement recipient's participation in the entitlement program. What does that mean? I've never dealt with an entitlement city that terminated their participation in the program. I've dealt with entitlement cities that chose not to receive their funds at all, but I've never had one that terminated their program. But if that were to happen, the rules apply for 5 years after closeout of that entitlement recipient's participation in the program. So if the use is changed to something that does not comply, you must reimburse your CDBG program at the current market value, just like that subrecipient that we talked about a minute ago. And the regulations that cover this are found at 2 CFR 570-505. Keep in mind that for a state grantee, the rules for this are different because you're dealing with units of general local government. So state rule is based on property acquired or improved in whole or in part in excess of the threshold for small purchases that Dion mentioned earlier. So that's the dollar threshold under the state program. So the rule is slightly different there. So I think that's the last slide that we have, and we can now open it up to deal with any questions that people might have or comments that you might have.
There's about 40 questions, and I think we are really almost at our time limit. So what is the protocol if we're not able to answer all the questions? Can you answer that, Dion?
Well, we actually have about 45 minutes, I believe, left in our time. So we should be able to get through a reasonable number of these. And then we can also respond to some of them in writing to kind of start cleaning it up a little bit. And they will be able to see those written responses as well.
Great, thank you. I had the time mixed up. Okay, so I'll read the questions and I think any of us can answer these. So how about time processing invoices for rehab program? Would costs be charged as general admin? I would say the answer to that is no. There's HUD CPD notice 13-07. Would encourage you to look that up either on the HUD exchange or through, you can just Google it. And there's actually a chart at the end of that guidance that gives very specific examples of what's general admin and what's activity delivery costs. And processing invoices is spelled out as a activity delivery cost, not general admin.
And I agree, Michelle. Keep in mind, that's an activity, that's a cost associated with administration of a specific activity, not the program as a whole. So I agree with you.
What about reporting and voucher reimbursements for an activity? Would this be an ADC? I think that's what we just answered there.
Yeah.
So again, if it's processing voucher reimbursements for a program activity, then that's considered an activity delivery cost. Okay, what are considered fair housing costs under admin? Dion, could you take that one?
Sure, absolutely. So pretty much any of your fair housing costs related to fair housing planning, either your analysis of impediments, your assessment for fair housing services that are provided to the community, or fair housing month activities can all be done under planning and admin. You can certainly choose to provide some services under public services. Just be aware that they would contribute towards the 15% cap.
Great. Okay, I hear you saying GA is 20%, but I thought it was, and we allow a 7% portion of award for GA. Is this incorrect? Yes, that is incorrect. So planning and general administration combined has a 20% cap. There are other programs such as home or ESG that have a lower than 20%, and that may be the point of confusion. But for CDBG and CDBG CV, 20% is the cap.
For grantees that are entitlement communities, we understand, of course, that states have different limitations and much smaller percentage numbers.
Okay, great. Thank you for pointing that out.
And I might add, one of the things that a grantee has to think about when they're dealing with this is you've got subrecipients that might incur general planning and admin costs as part of their program. So you need to think about that when you're developing subrecipients and subrecipient agreements in order to not only cover your costs, but also cover their costs as well.
Right. Because the 20% cap applies to your entitled grant award, not just the recipient, but subrecipients as well. So are you taking a portion of the 20% cap and applying that to GA? I'm not sure I understand that question. Either Dion or Bill, do you want to try to respond to it?
I don't either. We've talked about this. It's a 20% cap for general administration period. It's not apportioned out in that sense.
Right. And if they're dealing with other programs, like for example, CDBG disaster recovery, where it's 20%, but it is specifically portioned out in terms of how much can go towards admin versus planning, that could be a misunderstanding. But for the regular CDBG program, it's 20% overall, and there's no defined split between general administration and planning costs.
Right.
I think I'm reading the questions from the Q&A box, and they're slightly different than what's being shown on the screen.
They're the same questions. It's just that they might be organized differently because of the ordering that can happen in Slido in terms of questions being pushed up because people are clicking and thumb upping them, or the most recent ones, but it is all the same questions.
Why don't I just read them from the screen though, because it'll be easier to follow.
Absolutely.
Okay, is completion of environmental reviews considered general admin if in connection to home rehab? The answer to that is no. That would be an activity delivery cost. Can you start using 2021 admin in January for program year 2022? Will this be reflected on PR 26 for 2021 since you haven't received 2022 funding? I don't know that I can answer. Can you answer that one, Dion?
So it gets a little confusing, and I'm going to assume that their program year begins in January, which obviously is one of the major things that would be different for various grantees. So if we assume that their program year begins January 1st and it's their 2020 2022 program year and they've not yet received those funds, then obviously they can use their existing administrative dollars to continue carrying out and meeting their administrative program requirements. You do see on your reports the years that those funds are obligated from, and then there are additional reports that speak to when they were actually expended. I have to be honest, it's been a long time since I've lived the dream of micro strategies and the PR reports in IDIS, so I cannot speak specifically to the PR 26 report. But if they would like, I would suggest that they submit that question to the IDIS Ask a Question desk, and they can provide them a very specific answer to that question.
Okay. Do we have a cap of how much PI can be used, program income can be used towards admin now? Again, that cap is the same as your regular CDBG. It's the 20%.
Correct.
Admin and planning.
Yes.
Okay. I think I answered what about reporting and voucher reimbursement. I'm gonna go back up to the top. What can miscellaneous revenue be used for?
It's the broadest based source of funding you can have. You can use it for pretty much anything you would like. You're not subject to the normal CDBG eligibility and national objectives requirements.
Okay, is there a limit to how much program income can be spent on public service each year? And also, is the 20% cap included in this? So there is a 15% cap on public service, and that would include your program income. And I'm trying to understand, and also is the 20% cap include, I think the answer is the 20% cap applied to program income? And the answer to that would also be yes. Can you explain the difference between program income and applicable credits? Bill or Dion?
I'm not sure I understand the question.
I'm not sure I do either. Okay, if someone could type in something a little more explanatory, maybe we can get back to it. So what if a CDBG program, funded program charges program participants an activity fee? Is that fee considered program income? I think the answer to that is yes. If a CV project has, here it goes. If a CDB project has PI, program income, associated with it, to verify, the program income still must be used first.
Yeah, I don't think the rule changes for CV. If you generate program income, be it the regular CDBG program or the CV program, that money must be expended before you draw down any more grant funds, right?
That's right. Can you classify amounts under 25,000 as program income? You can use your miscellaneous revenue for CDBG activities, but you don't have to. I think that's the distinction.
Correct.
Many cities save up their program income and only use it for program income only applications and projects. Is this appropriate? I think that's totally at your discretion. I would just be cognizant about the point that Dion made before, and that is to make sure that you're not going to exceed that 25,000 because you're not thinking strategically about how much of your program income might be received in a particular year.
I would note, however, that if what you're saying is that you're receiving program income in and you're saving it up to use it all on one specific activity, so you have a program income only activity, unfortunately, that is not in keeping with the requirement that program income be receipted as received and used first. So it could be that while you're saving that up, if you're drawing down out of your line of credit for other activities, then you are not utilizing the program income appropriately, because it does have to be used first before you can continue to draw against your line of credit.
Okay.
The only exception, of course, is a revolving loan fund.
Right. Does program income have to be used for a similar activity, or for the next requested reimbursement regardless of type of activity or project?
I think we just answered this.
Yeah.
So unless it's a revolving loan fund, it does need to be used for whatever you need to draw for next.
Correct.
Okay, if you get program income from, say, a home rehab activity, can you put that back into the rehab program specifically? Or do you have to use it on the next draw regardless of whether or not that is a rehab activity? Well, first
We
of all,
touched,
go
go
ahead.
ahead. Well, we touched on that earlier. You can't reserve it for a particular activity and hold it back. You still have to spend it before you draw down any additional grant funds.
But you do not have to specifically use it for a rehab activity. I think that's the question.
Correct.
Right. Does the 25,000 threshold apply at an individual subrecipient level or at the grantee level?
It's actually combined. You have to look at the total amount of program income generated at the grantee level and the subrecipient level. And that becomes your threshold for 25,000.
Does miscellaneous revenue still need to be receipted in IDIS, reported as cash on hand? I think the answer to that is no. You do not have to report miscellaneous revenue if it's below the 25,000.
Correct.
Kind of jumping around. Let me see if I keep following. Do you report interest on a revolving loan fund as program income in IDIS or retain separately without reporting and then submit funds to Treasury? I don't know the answer to that.
I don't either.
I would suggest again that you submit a question in the IDIS Q&A. And to get that specific answer. Okay, is HUD considering another waiver? Due to COVID and supply chain, there have been a delay in funding activities. And I'm not sure what kind of waiver you're talking about. Is that if that's a waiver around timing of expenditure or extending the grant period? Yeah. I don't know that there's been a waiver.
I think regardless of what kind of waiver they're asking about, that's probably not a question that we can speak to.
Okay, great.
Correct. And I take that question to be directed toward the regular CDBG timeliness test, where HUD has already indicated that they will take a careful look at that given the overall circumstances. So you're right, there's not an absolute answer to that at this point.
Okay, here's a good one. Is coffee for subrecipient staff allowable as an office supply cost? I think the answer to that is no, because food is not allowed. That's a 2 CFR 200 requirement. At what point should the cost allocation plan be created and submitted, reviewed by HUD or the state, etc.? Normally, a cost allocation plan is developed based on your prior year audit, or it could be based on your current year budget. And I think it's going to be up to you to decide which one you want to use. So, for example, if you're receiving a lot more money than you received in the previous year, you might want to use your budget as the method for developing your cost allocation plan, as opposed to your prior year audit. Irrespective of what you choose to use, you first get a provisional plan approved, and then at the end of that grant year, you have to, what they call, true up. You know, you compare what your estimated costs were, or what your prior year costs were, to your current costs, and there is a true up that's done to reconcile those two things. Okay. What is not program income? Can you clarify again regarding special assessments from LMI, non-LMI?
I think I can cover that. The regular CDBG program regulations have a provision in them that address this question of special assessments. Many cities have what are known as special assessments to recover the costs of public works and public improvements. A good example would be you've got a neighborhood where you're going to put sidewalks in. And under their non-federally funded, non-CDBG program, they would assess all of the residents along those sidewalks a fee for putting in those sidewalks. The CDBG regulations say that if you use CDBG funds, you cannot recover those costs through a special assessment for low and moderate income households. But there's nothing in the rule that says you cannot recover those costs from non-low and moderate income households. So if you do that, these rules then come into play as we discussed during the webinar itself. So you need to take a look at that section of the regulations and see whether or not you're doing special assessments. And if you're doing special assessments against non-low mod income households, those dollars would be considered PI.
Okay, great. Thank you, Bill. Do timeliness tests include program income and allocation amounts? Yes, they do. So when your test is administered, which is typically a certain time, I think it's 60 days before the end of your grant year, then program income is included in that calculation.
Let me mention something there, Michelle, because there is a provision in the HUD, I would call them operating procedures regarding CDBG timeliness. There are those occasions when an entitlement grantee gets a sudden and unanticipated bubble, if you will, of program income near the end of their program year. And while overall they were doing well on timeliness, all of a sudden they get this bubble of program income, let's say 62 days before the end of their and it throws everything off. We used to take that into account when we contacted that grantee and asked them to do a workout plan. And if we were convinced that this was a unique circumstance that was not going to happen again, there was no real problem. However, if it was something that they could see would recur and create a problem for them, then they might need to address it. So it's really intended to deal with that unexpected bubble of program income when someone suddenly disposes of a piece of property 62 days before the end of your program year.
Okay. How would the additional program income be entered in IDIS if it is to be spent first? Do we allocate to next activity seeking reimbursement?
I think we addressed that earlier. It has to go to the next, whatever's up, whatever the next expenditure is, right?
Right. Okay. Regarding 10% de minimis rate, you mentioned an annual $35 million federal limit, but is this being waived at all due to all of the CARES Act and now our dollars that counties are getting from the feds? I think the answer to that is no. I've not seen any waivers of the 10% just because you're getting a lot more money. Do federal procurement policies supersede local procurement policies? I think we talked about that. So your local procurement policies are the ones that you should be in compliance with, but your local procurement policies at a minimum have to meet the federal procurement policies.
Correct. You have to follow whichever is the more stringent.
Can you use a state bid list for procurement purposes?
Well, there are certainly times when you can, but the first question that you have to look at is whether or not the process of putting together that list followed the federal procurement requirements or the requirements of the state, because states do have options to not necessarily specifically follow 2 CFR Part 200, but to have policies and procedures and requirements that align to it as defined by their own purchasing documents. So that's, in my experience, that's a solid maybe, but there's about 8 more questions that you would have to answer to determine if that's a yes or a no.
And I think if memory serves, there's also a federal list that's maintained. I think it's by GSA, isn't it, of contractors that that have gone through the process, Dion, that you just described, and you can contract with them directly.
Right, there's a federal list, but many states also maintain lists for, especially for things like vehicles and supplies and equipment.
Okay, great. Hasn't the micro purchase limit increased to 50,000 according to 2 CFR Part 200.320? I think Dion correctly pointed that out to us. So yes, it has increased to 50,000. Do grantees always have to use RFPs for environmental or engineering services? Or could these services fall under the small purchase threshold or get 3 quotes for these services? I think that would have to be, again, in compliance with what your local procurement policies are. I don't think they're specific to environmental or engineering services.
Right, and the one thing I would point out is that architectural and engineering services often utilize RFQs where price is not an initial consideration as opposed to an RFP, regardless of the size of what they're looking to bid out. So there are some exceptions in the procurement standards usually related to A&E services specifically.
Great. In a homeowner repair program, is it okay to procure a contractor who is not the lowest bid?
Yes, the answer to that is yes. The key, I think, is that the wording in the OMB requirements is you select the lowest responsible bidder. We often used to get calls from entitlement grantees that say, we just looked at the bids for a particular procurement thing, and there was someone on the list that way underbid everybody else. But when we look at their qualifications, we find out they have no track record. They've had a history of problems of not delivering, you name it, and they're not considered to be a responsible bidder. So you have to take that into account, particularly in rehab. So you can dispose of any bidders that, in your view, that you can document are not responsible.
Great. In a different session, there was mention that for CDBG, we are not required to do a competitive solicitation. We are an entitlement municipal government entity trying to determine if we are only trying to award public services if we are required to do an RFP.
So I think that was actually in a session that I was in either yesterday or the day before, and we were speaking specifically around selection of subrecipient partners. And the fact that you have a variety of options in terms of how you select your subrecipients. Those same options do not apply when you're selecting contractors or other types of partners.
Great, thank you, Dion. I am confused about program income. You said if there is less than 25,000, you don't have to remit to HUD, but how could you even have $25,000 to remit if program income has to be spent first? Again, I think we've talked about this. As long as you're below the 25,000, you do not have to remit it to HUD or report it, but you have to be careful that you're not humming along throughout the year and then all of a sudden you're at 28,000 and you're exceeding the 25,000, which means that all of the initial money that you received is subject to program income and has to be remitted. Okay, I'm going to go back up to the top. Can a nonprofit recover indirect costs if they submit a public services proposal with an approved allocation plan? And if so, will costs be subject to public services cap? Let me read that again. Can a nonprofit recover indirect costs if they submit a public services proposal? The answer to that is yes. If they have an approved allocation plan, then you as the recipient must accept that plan, and they can recover those indirect costs. But those indirect costs plus their direct costs will be subject to the public services cap.
Correct.
Okay.
And I just want to reaffirm what you just said, Michelle, because this has created a lot of confusion at the local grantee level, where prior to 2 CFR Part 200, it was let's call it optional to consider reimbursing indirect costs. And with 2 CFR Part 200, there has been specific guidance issued that has clarified that it is not optional. And if you have a partner that has an approved indirect cost rate or wants to take the de minimis rate of 10% and is eligible to do so, you cannot decide to not allow for that. And that's been a major point of clarification, I would say probably for the last year or so, as grantees have become more and more aware of that.
Yes, and you cannot lower. So if someone has an approved cost allocation plan, and let's say their rate is 20%, you as the recipient cannot say to them, you can only get 15%, right? So it has to be done within the confines of your grant agreement, but you cannot require them to lower their indirect cost rate. You have to accept what's been approved. Okay, in procurement for home rehabilitation, if a project is bid competitively, but only one bid is received, does that meet the requirement? If you have the
Yes,
documentation that shows you sent to multiple contractors.
that's the key. They show that they have the documentation to show that they sent it to multiple contractors. That last category of procurement that we talked about, the non-competitive thing, has a specific provision in it that says you went through a normal procurement competitive process and you only got one response. Can you award the bid to that? Yes, you can. But you have to show that you went through a normal, responsible, competitive process. And the key here is they show documentation, show you sent it to multiple contractors. That's good.
Okay, another procurement question. Are MBE or DBE recommended too?
Not sure what that means. Do you sense, you know what that means?
No, I'm not sure.
Well, I know what I know what the acronyms stand for, and certainly when you're looking at your procurement process and maximizing competition, you're always going to consider minority, women, and disadvantaged business enterprises, as well as the Section 3 requirements that come into play and so many other considerations. But those should be written into your procedure documents, as well as any competitive solicitations that you issue, in terms of how you're going to consider those and what specifically that means in any given procurement situation. So they certainly exist and are recognized, but there's no specific requirement to include bonus points or anything of that nature. But you do want to read the updates to the Section 3 requirements.
Please discuss how grantees should use factors other than cost to make an award, particularly how the factors are weighted, how scores will be determined, and how prospective bidders will be made aware of the factors.
I can kind of jump on that one. It kind of depends on what you're procuring. For example, with professional services, we mentioned there are a lot of factors you would take into account other than just cost. Cost might be one of the factors, but the experience that entity has, have they have a history of other problems with other projects, things of that nature. What I tell grantees is anytime you're going through that kind of process, you have to have written standards in place, and you have to follow those standards and keep records that you did so. So maybe you would have, let's say, 5 factors that you take into account on a given competitive proposal. Those factors should be publicized. Those factors should be weighted in some way. You should go through the proposals on an objective basis and score them. And you should have all that information in your file afterwards to show that you went through that process. But it doesn't specify exactly what those factors must be because it varies from procurement to procurement.
Great. I think we answered this next one. Can you give us the reference for the new regulation for the micro purchase threshold? And I believe that's 200.320. Can you correct me if I'm wrong about that, Dion?
Yeah, and you're on. And there you go.
I'm sorry about that. I'm sorry, I can't see the question.
It's on the slide, on the screen. You know, it's on the screen. Can
I'm
you
not-
give us the reference?
Oh, sure. So if you go to 2 CFR Part 200, and I'm sorry, I answered this in the regular Q&A. If you go to the online version of 2 CFR Part 200 and you go to the micro purchase threshold area, which is actually 200, 320 A1 III, it's updated in the online version of 2 CFR Part 200, so they would see it there.
Okay, great. Procurement, is there a definition of construction? For instance, is a window replacement project in multiple group homes construction? Just wondering if the small purchases procedures would apply here, since it would be considerably less than the 250,000.
The regulations, the CDBG regulations don't have, I don't believe, a specific definition of construction, but the window issue would certainly be part of the construction, and that process would apply. But the key here is you say that the total cost is less than 250,000. So you can go through the small purchase approach. And the small purchase approach is not a formal bidding, closed bid process or sealed bid process, but you typically go through some kind of a competitive process where you might go to multiple vendors and ask them for some indication of what they would charge or what it might cost. So you have to have some kind of documentation. And as I always tell people, regardless of the level of procurement you're engaged in, you always start with a cost estimate. Somebody independent who works for you or is independent of the process needs to tell you, for this given kind of procurement, my best estimate is the cost should be X. And that way you have assurances that you've met that cost reasonableness requirement.
Okay.
The one thing I would add on that one just quickly, however, because they were asking about construction, is if it is a construction activity, then obviously sealed bid will come into play there. So even though it might be below the $250,000 simplified acquisition threshold, construction projects are subject to the sealed bid process.
Okay, what about a public facility? Oh, I don't know. Oh, there it is. What about a public facility that was constructed with CDBG funds? We have a public facility that was constructed in 1998. I'm not sure what the question is.
I think it might relate to, so it seems like this particular area of questions is a lot about change of use. Because there were a bunch of them that all came in around the same time when Bill was talking about the change of use at the end of the presentation.
But what's the
Yeah, I'm reading this to mean that if you've got a property that did change in use, but it still meets a national objective, then you're not required to dispose of that property. Therefore, you would not generate any program income. So that's the way I'm reading this question. Does that make sense to you all?
Yeah, I think Michelle had actually read the question that was immediately below that. What about a public facility that was constructed with CDBG funds?
Okay.
Yeah. We can go back up to that one, Bill.
Okay.
If a property had a change of use and still meets the national objectives, is this not program income? That's the one I think you answered.
That's the one I was addressing. I'm sorry. I was looking at the top question, but that's a key. If it's still, you could change national objectives theoretically, or you could change use and it still is a low and moderate income benefit activity. And as long as it's meeting those requirements, you're not required to dispose of the property, and therefore you would not generate any program income.
Great. Some city auditors are not auditing the CDBG program because the city received many more federal funds through CARES Act and ARP. Is the city okay to not audit the CDBG program in this circumstances? I'm going to take a shot at this. Normally, when an auditor is auditing, they're doing a risk assessment up front. So if you've been managing a CDBG program for a number of years and you've not had any difficulties with it, no prior findings or issues, the auditor may choose not to audit that particular program. But because CARES Act and ARPA funds are new funds, that would essentially be considered high risk. And so they may choose to, or make it a requirement to audit those programs since they're new. Okay, anything you all want to add to that, Bill or Dion? Okay, can subrecipients also have a admin line item? And how does this impact the 20% admin for the recipient? Does the subrecipient's admin expenses have to come out of the 20% recipient cap?
Yeah, I'll give a shot at that. The calculation is based on total general admin and planning costs by both the recipient and its subrecipients. So you have to account for general admin and planning costs in a cumulative fashion and apply it to that particular program. So if you've allowed a subrecipient under your subrecipient agreement to charge general admin and planning costs, then they're going to have to account for that, and that's going to be part of your overall program.
Right, okay. Can you go over the 5-year time frame for repayment of funds for subrecipients? I don't know that I'm sure what that means.
Now, I'm not sure either. Can you go over the, go ahead.
I think that might again relate to the change of use.
Okay. So what's
So-
the answer?
So Bill, on the last slide,
Yeah.
the requirements related to subrecipients.
Yeah,
and-
you've got a subrecipient and your relationship with them ends. There's a minimal 5-year time frame that applies to any real property that they acquired with CDBG funds. You could extend that if you like. I know some grantees that did, but if that property were to go, let's say for whatever reason, that organization goes out of business and they stop operating that real property for the purposes that were intended and it no longer meets a national objective, they would be required to dispose of that property and return those net proceeds to the grantee, and that would be considered program income. Is that what you think this is dealing with?
It is.
Okay.
Okay, how does change of use impact CV projects?
Interesting question. I'm thinking of, off the top of my head, of some CV projects that I know of that some of our grantees have funded. And the one that comes to mind is they assisted a local homeless shelter to develop an additional facility for families, particularly families with children, because of social distancing requirements. And the question then is, let's look at this long term when CD funding runs out. What will you do then? And part of that process is that they wanted to get reasonable assurances from that operator, in this case, a homeless service provider, that they had the resources to continue to operate that facility after that relationship has ended. But this is slightly different for CDBG and CV than for regular CDBG. You have to, the considerations are slightly different because of the nature of the program. CV has a lifespan associated with it. There will come, what is it, 6 years? So there will come a point when that program is going to be concluded, and then those issues of change of use would kick in.
Great. Are small purchases required to conduct a proposal process?
Not a formal proposal process, no. What you would do is you would go out and maybe ask for price quotes or something from a variety of vendors and document that. But I still always tell people the key to that is do your own independent cost analysis before that, so you can be sure that whatever you receive in response is cost reasonable.
Do you anticipate the 15% public service cap to increase anytime in the near future? This is a huge barrier to meaningfully serving our community's priority needs.
You know, for CDBG CV, there is no public service cap, right?
That's right.
that only applies to your regular CDBG funding. And I don't want to bore everybody with the history of this, but I was at HUD when this whole issue was first argued when CDBG was created. And it was critical that they recognized there was a need for public services to do comprehensive neighborhood revitalization. Congress did not want CDBG to be a public service program, the regular program. Hence, the 15% cap was put in place. It can be done, but Congress clearly wanted it to be limited.
Okay.
But that public service cap does not apply to your CD funding. One of the exceptions that was made was that public service, that 15% cap was exempted under the CD program.
Okay. If you have an award of 100,000, your grant funded admin cap would be 20,000, correct? That would be admin and planning. Keep that in mind. And your
Right.
program income admin cap would be 20,000. Therefore, you could spend 40,000 on admin. I think the answer, I'm trying to make sure I understand it, but I think the answer to that question would be no. If you received 100,000 from your grant and 100,000 in program income, you could spend 40,000 on planning and admin, but you couldn't spend 40,000 on admin if you're only talking about your $100,000 grant.
In other words, you can spend 20% of your grant plus 20% of your program income, and that in effect becomes your cap, right?
Right. Okay, I think we've answered the miscellaneous revenue question a few times. Okay, so if environmental review and writing specs for projects is a delivery cost per activity and not considered admin for the grant, where does the payment for these activities come from? Especially when the funds for the activity is used for construction costs. I think the answer is, if I'm reading this correctly, it's coming from your program budget or your program expenses. It's just not a general admin expense. Are you all reading that the same way?
Yeah, I would treat it the same way I would any activity delivery cost, Michelle. The cost is charged to that particular activity,
Right.
and not to your general admin and planning category.
And the only thing to keep in mind is if for some reason that project were to not come to fruition and meet a national objective, those expenses would end up having to be reallocated over to the admin line.
Good point.
Okay. Can you make a distinction regarding program delivery costs charged as a portion of staff salaries for program executive directors, financial directors versus line staff administering an activity? Should the former charge their time to planning and admin and not activity delivery?
I don't see a clear-cut answer to that, because I've worked with organizations where the executive directors did nothing but general admin and planning work. I've also worked with entities where the executive directors get involved in activity delivery. So I wouldn't say that just because your title is executive director, you can't charge your costs either to general admin and planning or activity delivery. It really depends on the actual things that executive director does.
Right, but that should be documented either through their timesheets or personnel activity reports, what activity that financial manager or that executive director is performing to determine whether it's admin or activity delivery costs.
Michelle, I see we're getting close to the end of our allotted time, so why don't we take one more question? Is that okay?
Okay.
And just so that folks know, because I see a question about why are some questions not being answered, I am frantically typing to try and answer some in writing. And then the amazing tech team is pasting those into Slido for us. So we're working through it. We had almost 70 questions, so we're working on it.
Okay, we're going to take this last question and then I think we'll be out of time. And what's the protocol, Dion, for questions that didn't get answered?
We can provide those in writing as I'm doing right now, and then they will continue to show up, is my understanding, for folks to be able to come back and look at.
Okay, great. If a homeowner wishes to use a contractor that is higher than the lowest responsible bid, both bids were responsible, can that contractor be awarded the bid if program funds only pays up to the cost of the lowest responsible bid?
That's an interesting question. I don't see any reason why that could not happen. I would go one extra step to show a little due diligence here and find out why it is that homeowner prefers that other contractor. Is it because they've had an experience with that contractor and they know them and they feel comfortable with them and they've done good work? I would be a little bit careful if that other contractor is the brother-in-law of the homeowner. So I think you have to kind of dig a little bit deeper in this regard.
Okay, so that's going to be our last question. After the call, we'll, as a team, we'll go back and try our best to answer all of the questions we didn't answer verbally. We'll try to put the answers in writing. How would they go back and get access to that, Dion?
They should be able to see it in Slido, but I'm going to defer to Mark Gifford to be able to speak to the magic of their technology.
Yeah, so they will be able to see it in Slido. If they're the person who asked the question, then as soon as the reply hits, it'll stay in their feed and it'll stay there forever. If they come back and they're looking for a question that was asked by someone else, they may not see it if it's during the later sessions of the day today, but then we'll restore all the questions from the entire day when the conference concludes.
Okay, great. Bill, you want to wind things up?
Well, with that, I want to thank everybody. Michelle, I want to thank you and Dion particularly. I think this has been an interesting and challenging and actually fun session. I've enjoyed it. And thanks everybody for the work that you do every day to help folks who really are in need, particularly at these times when COVID is such a prominent issue for everybody. We appreciate all the work that you do, and we appreciate your participation in today's session. Thank you all very much.
Thank you, everyone.